As an individual investor, we don't have the time or the resources to perform in-depth research of each and every company that we come across. Hence, we need to have some sort of basic filter through which we can decide that, okay, these are the companies that are worth researching in depth, right? Because obviously not all companies are going to be that good. So that is what exactly I want to share today, a very basic filter or a very basic process that you can go through to understand if any company, if a certain company is worth all the research that you might want to do later, right? Now, this is just one of the techniques, but this has been the most helpful technique for me. And one important thing to understand here is that this technique is would be most helpful if you're looking to invest, or if you're looking to, look for opportunities to invest for a longer time scale, because the metrics that we're going to use in order to filter companies are more aligned towards long-term investing. And if you're looking for a rule-based system, or some sort of trading or short-term opportunities, then this method might not be most helpful. There are different techniques for that. All right, so what we're going to do is I'm going to pick up a company, right, and I'm going to show you that what financials do we need and what metrics that we're going to calculate to decide that whether we should study this company into detail or not. All right, so I have a basic template here. I know it looks slightly weird right now, but as we move forward, we'll fill this out and then we'll see that how it works. So what I have is, let's say I'm going to look at the past 10 years of data. I have additional 5 years because, if I decide to invest in that company, then I'll just keep continuing reviewing, using this method to review it as well. Right. So the first thing that we need is to get the annual financials. And no, we're not going to go into the annual reports of 10 years. There are plenty of websites, right? There is Screener, RateStar, Ticker Tape. I don't know. There are so many websites, StockEdge, from which where you can get these annual financials. In all of these websites or apps, you'll also find the metrics that you're going to use. But I prefer to calculate the metrics on my own, because then that way I can use the formula or the version of the formula that I feel is best suited to my understanding, right? So what are the financials that we're going to need? We're going to need revenue, right? Then we're going to need EBIT, PAT, CFO, right? So we have three items from the income statement, one from the cash flow statement. Then we're going to have equity, then current assets, non-current assets, current liabilities, and non-current liabilities, right? So basically, the broad financials on a high level basis, right? Now the metrics that we're going to use are ROCE, ROE, right? So ROC and ROE are the most basic metrics that we're going to use, right? ROCE is return on capital, ROE is return on equity. Now, in any business, we invest capital and we want to get the maximum return out of that capital. Any business that is not getting return on capital isn't really creating any value for its shareholders or the business owners, right? So that is a return on capital is the most basic thing that we must look at. Now, what we're going to do is we're going to break down these two ratios into its component ratios, which is basically known as DuPont analysis. So ROC can be calculated as EBIT margin into capital turnover, and ROE can be calculated as PAT margin into asset turnover into financial leverage. So we have EBIT margin, then we have PAT margin, then we have asset turnover, then we have capital turnover, right? And then we have assets upon equity. So this is basically financial leverage. Then what you can do is additional basis or additional measure for financial leverage is non-current liabilities upon equity. And then finally, net working capital, or just you could also call it working capital, which is current assets less current liabilities, right? Then, so the first part is to look at ROC and ROE, and the second part is to look at growth, because no matter how high returns on capital you can generate, you need to reinvest those, you need to have opportunities to reinvest that capital as well, and in order to grow, because if you're not growing, then the business just keeps doing the same thing over and over again, and you're not going to compound returns at a higher rate. So we are going to look at the growth in revenue, right? Then we're going to look at the growth in EBIT, PAT, CFO, equity, and assets, right? So I'm not mentioning liabilities here, because if I have an idea of the growth in equity and assets, then I can deduce something about the growth in liabilities as well, right? So what I've done is I've already downloaded, or I've actually manually input these financials here. So I already have them here, right? So I'll just take these. Right now, this financial data is for a real company, right? but I have redacted the name just so that we can focus more on the process than on the company. So these are all the financials. Now let's quickly apply the formulas. The version of ROCE that I use is EBIT upon what you call equity plus non-current liabilities. I know that all non-current liabilities do not count under capital employed, but this is a rough overview, or this is a high level understanding of this, right? For ROE, we do PAT upon equity, right? For EBIT margin, again, this is very simple. EBIT upon revenue. This EBIT does not contain non-operating income, right? So I think that is a better way to do it. Then we have PAT margin, which is PAT upon revenue. Then we have asset turnover. So asset turnover is revenue upon assets, which measures that how well basically the company is utilizing its resources, which are the assets. So asset turnover. Then we have capital turnover. So capital turnover is also revenue upon the capital. So capital is non-current liabilities and equity, right? Then we have assets upon equity, right? So we'll do assets, current assets plus non-current assets upon equity, right? So this is basically a measure of leverage, right? Because this tells us that how, I mean, a dollar worth of assets versus a dollar worth of equity, right? So the balance basically is the liabilities. So then you could also do a non-current liabilities upon equity, and then we finally have current assets less current liabilities. So this is working capital. Now, one thing to understand here is if we do it just for 1 year, it doesn't really make sense, right? Even if you do it for the latest 1 year, it doesn't make sense because 1 year doesn't tell anything substantial about the business, especially if you're interested in investing for long term. So that is why we've chosen a 10-year period. I think 10 year is more than sufficient, right? And we've calculated all these metrics. Now we're going to calculate growth as well. So I think it is very easy to calculate growth. We have revenue, current year revenue minus previous year revenue minus 1. So I think then EBIT, PAT, CFO, equity. I'll just copy the formula. For assets, I'll have to apply a sum formula. So we'll do a sum of current assets, non-current assets upon a sum of the current assets and non-current assets for previous year and minus 1, right? So we have the growth for all of these things as well. And I've copied all the formulas. So this is basically what we need to do. This is, we've had the financial data, we've calculated some basic metrics, and we've calculated the growth rates of different financials as well. Now we're going to do some basic analysis now with the metrics. So we're going to use ROCE, ROE, EBIT, EBIT margin, PAT margin, asset turnover. I'm not using capital turnover. Okay, let's use capital turnover as well. Asset turnover, capital turnover, and assets upon equity, right? So it is your choice whether you want to break down ROC or ROE, or if you want to break down both. I'm just sharing the different options that you can have, right? With growth, we're obviously going to take all of these, right? We're not taking the growth of all the financials anyway. So I think these few make sense. Now I'm just going to apply the formulas, the median, right? Then maximum, right? Now what I'm basically trying to do is trying to get an idea of how varied are these, right? And how does the company perform under different circumstances or under different time periods, right? So I'll get an idea about all of these things. Now I'll just copy paste this formula: ROE, EBIT, PAT, ATO, CTO, AE, right? Okay, I'm sorry. Let's just do it again. Yes, so this is basically, we have all the information here. Then we'll look at growth as well again. So median growth, maximum growth, minimum growth, and finally the CAGR formula, which is slightly trickier. So what we're going to do is we're going to take the most recent one, then the older one, then we're going to do, we're going to raise it to 1/9 because this is technically 9 years of data, and then we'll subtract 1. So I think, yeah, I think that's the correct formula. And we're going to apply this for the various ones, EBIT, PAT, right? I think this might be this formula might be wrong. So yep. So for this we'll do sum of current assets and non-current assets, right, upon sum of the older year, then 1 by 9, then minus 1. Right. So now we've done this basic analysis. Now, what's the next step to do? Because we've calculated all these things, but now how do we make the decision? So now, what you could do is you could apply the filters for ROCE and ROE, right? And again, you could also apply filters for growth, right? Now, for an ROCE on ROE, anything that is above 15, I think that should be good enough, or anything that is above 20 could be very, very good, right? So now this, why is this important? Why is high ROE or a high ROCE important? Because in order to grow, and any company would want to grow if it wants to create more wealth, or any businessman wants to create more wealth, right? They need more capital to grow, right? Some businesses require a lot of capital, some businesses do not require a lot of capital, but still, for any business to grow, there is requirement of some capital at least. Now, the company can either generate capital internally, which is through its operations, or it can take external capital. And obviously, if you're generating capital internally, then uh, you wouldn't want to approach getting capital from outside. It is better if you're generating capital internally, because you might not always have access to capital, external capital, so to speak, right? So you generate more returns on capital, which becomes the capital for your growth, right? And the faster you can grow, the better it is, right? Now, also one thing to understand here is that you're looking at large public companies, so to speak, right? Even the micro caps or the mid caps companies are still large enough, considering all the businesses in India, right? So a lot of times you would see very high growths in smaller companies, in very small companies, but that sort of meteoric growth is not present in most of the public companies. So their growth is more stable, more reasonable. But I think anything about 10%, 12%, that is very good. Now, obviously, you're not going to, what few common things that you'll see is that there are times when there is negative growth, right here, right? Then there is negative growth in EBIT and PAT as well, and there are years then where there is extremely high growth as well, right? So there would be some sort of volatility as well. Now it is up to you that what sort of volatility are you okay with. Another thing that I would request you to look for is that what are the current liabilities or non-current liabilities, and especially the assets upon equity, right? If this assets upon equity moves beyond, let's say, 3, right? So there, that means for $3 worth of assets, there is only $1 worth of equity, which means there is $2 worth of debt, right? Both short-term and long-term debt, or both short-term and long-term liabilities, right? So if for a non-financial company this goes beyond 3, then you might want to take a look, and you might also want to take a look at non-current liabilities versus equity, which is, so as you can see, if we analyze these companies' metrics, you could see that they have very healthy ROC, right? And the minimum ROC is also 18. So they're doing pretty good. They're able to easily generate returns on capital above 15%, and even the return on equity is great, right? It is more than the minimum return on equity is 19%. The margins are slightly more volatile, because the margins can be as low as 9.4 or as high as almost 30%, right? So this is slightly volatile, and it might be due to the nature of the business, right? Then similarly, PAT margins is also 7%, can be low. I mean, can be quite low. And the median PAT margin is 13.2, and the max one is 22.7. So again, there is also quite volatility, right? So if you take a look at it, then the minimum times 3, that's roughly the maximum, right? And the median obviously falls. So it is quite a range. Then asset turnover as well, you could take a look. So the median asset turnover is 1.28. I think because asset is a very large base, asset turnover will obviously be lesser than the capital turnover. But companies anywhere greater than 1, I think might be good. There are few companies that have exceptional asset turnovers as well, right? And then asset upon equity. So anything less than 2.5, I think would be very good, because there are a lot of liabilities as well which do not require payment, so to speak, right? Or they might be short-term liabilities which are, a normal course of business. So for ROC and ROE, what we're looking is greater than 15, 16%. Margins are, I mean, I think margins are something that we'd want to compare with the industry, so to speak, and we'd want to look at the trend of the margins. For asset turnovers, anything over 1, 1.2, that's good. right? For capital turnover, I mean, it's okay. Capital turnover would be quite high. I mean, slightly higher than that. So you could, basically do adjust the metric a little bit. For asset upon equity, anything less than 2.5 or anything less than 2 is pretty good. But I think up to 2.5, up to 3, it's still acceptable, right? Now, growth. So usually what we correlate shareholder returns with is earnings growth, and earnings growth are essentially the most important thing, which is in most cases we're looking at PAT as well. But the growth in earnings will also be a function of the growth in revenue and the growth in costs, so to speak, right? So we're going to take a look at that as well. Now, median revenue growth of 17% is quite healthy, to be honest, and CAGR is also 16.1%. Now, don't depend blindly on CAGR, because CAGR might hide the inconsistencies, right? So CAGR might tell you that, okay, 16% CAGR looks very healthy, but you want to have a company which consistently increases revenue year after year, right? And what you'd obviously want is the EBIT or the PAT CAGR, or the EBIT or PAT median growth, to be higher than the revenue growth, because what this means is that as the company increases in size, it is taking benefit of cost efficiencies as well, right? So that might be a very good sign. But I think we should not always be reliant on profit. We should also take a look at the cash flow from operations, and right. So we should also look at the growth in the cash flows, because profits are accounting, and but is real, and I think it gives you a good measure. So with this particular company, the cash flow growth is slightly uncertain. It's quite volatile. If you look at here, it's 40% here, 87% here, -9, -28, 451%, -65%, -4.9, 160%. So it is quite volatile. And what it might mean, because this company is in industry which requires a lot of reinvestment as well, and it also has longer payment cycles because it has longer term contracts. But this is something which should indicate that if you're going to look into this company into detail, this is something that you should really inspect, right? Now, equity is growing at a good, healthy rate, right? And so this is technically the book value of equity, so to speak. And the assets are growing at a comparatively slower rate versus equity. So I can deduce that, the liabilities are also growing at a slower rate, because equity is growing faster, and equity plus liabilities equals assets, right? So if I were to look at this company, I'll say, okay, yes, I think this is one of those companies where I would want to look into larger detail. If you have companies where ROC or ROE are consistently below 15%, and there are a couple of years where it is exceptionally high, I think that company is better avoided, right? So now this doesn't mean that I will definitely invest into this company, but what this basically means is that, okay, I think from a higher perspective, this makes sense to me, and I'm interested to research in detail into this company. And this company might make a good investment if the other things, the business model, um, the basically the business model, the operations, the industry, if I understand it well enough, if all of these factors fall into place, then I think this company might make a good investment. At this point, all I know is that it is a good company to look into, but currently I'm still not going to invest just on the basis of this information. But I think that if you're going for long-term investing, then this very basic filter can save you a lot of time, and it can also, basically direct you into areas that you look into detail, and it can also save you from companies that might not be very good investments, that might not be consistent enough. So what we're looking for is good metrics, and we're looking for good consistency. So to recap, I'll just tell you that there are two important things: high returns on capital and good growth. If both of these things are going well, and if both of these things are consistent, then that company might be a good investment opportunity. But for that, you should look into detail. So this technique, this method has helped me a lot. I hope you can apply this, and it can help you filter or stock opportunities in a better way, rather than getting so lost or overwhelmed about so many opportunities. I hope this helps you, and I hope you use this to identify companies for further analysis or investment as you might seem fit. So this is it for today. If you found this helpful, then please share it with someone who's looking for techniques to filter companies, and stay tuned for more videos on investing and personal finance.